Sorry, I was
That was-
just in my moment. Okay, and we introduced ourselves here because this is our own webinar. Hooray. I see some familiar faces in the attendance list, so hello. And as some of you know, before the pandemic, Peter and I were strictly tax controversy attorneys. So we help people who are behind on payroll tax, sales tax, audits, for whatever the reason. And that was our sole job. And then when the pandemic hit, we had to dig down deep into the CARES Act and figure out how to help these people survive, a once in a lifetime, hopefully, suspension of operations. What were we going to do? How are these businesses that were kind of on the bubble of viability, getting themselves back together? How are we going to make sure that they continued into the next, year, 2 years, however long? In the CARES Act, originally, you could not take PPP and ERC together. You couldn't, if you took PPP, you were no longer eligible for the ERC. And so we paid a lot of attention to PPP. It was more lucrative. It was $15,000 and $20,000 an employee versus the ERC, which was only $5,000 an employee for 2020. We worked through all of that. There was a ton of guidance. I fondly recall a Memorial Day weekend where new guidance dropped at 7 p.m. on a Friday. And Peter and I had a webinar at 9 a.m. on a Tuesday after Memorial Day, where they changed all the rules and we had to change our entire presentation, which I always really appreciate. That was kind of our life back then. It's kind of stayed the same, sadly, but this is where we are. December of 2020, Congress realized we were still in a pandemic, businesses were still hurting, and they realized they needed to get more relief out there. So what did they do? They said, you can use PPP and ERC as long as you don't use the same dollar twice. Then they said, we're going to increase the credit from $5,000 an employee to up to $26,000 an employee if you qualify for 2020 and 2021 altogether. This made the credit so much more lucrative and really helped these businesses kind of get back on track. I had some of my clients actually use the credit to offset all of their prior tax liability and still get some refund on top of it. So it was a really good result for them. Once we realized how we could do it and help our clients and work through all of those, we kind of pivoted and started helping other people that weren't our clients. We started helping restaurants and working with the National Restaurant Association and working with salons and daycare providers and, partnered with the Maryland Association for Childcare. We started working with other places that had restrictions, COVID government orders that restricted the business operations due to COVID-19. And since then, we've just been working with people and trying to help get them, these credits that they're entitled to. That's me and Peter. You want to start kind of explain the background of where we are?
Yeah, I'll jump in. All right, so just as a reminder for, what all came at you and your clients, during 2020, 2021, I mean, Paycheck Protection Program, Family First Coronavirus Response Act, FFCRA, which was, a credit for wages paid to someone who was sick with COVID or caring for someone, close family member. There was deferral of Social Security tax in the CARES Act. Half of it was due to be repaid on 12/31/21, the other half on 12/31/22. So if you took advantage of that or you had clients that took advantage of it, now's a good time to remind them that they need to make that payment. There was ERC, but at the beginning, sort of PPP took all the air out of the room. It was worth $15,000 and change to start, and the beginning program with the CARES Act, ERC was only worth $5,000. And so if you could qualify for PPP, that was the lane you chose, and it just made more sense. We had clients who were too big, couldn't qualify for PPP. So I remember early on, being down in my basement during the pandemic and working through, ERC stuff with Rebecca, like she said, to try to get clients help to pay their tax bill. There was also RRF, SVOG, which are sort of targeted programs for restaurants and for certain venues. And then of course there's the economic injury disaster loan, EIDL loans. This generally ended on 12/31/21, but it was a situation where the president said, every place in America is a disaster zone, which opened up some pretty favorable loan programs. ERC changed, and it's changed quite a bit. Of course, to start in the CARES Act, you had to pick a lane. Most people picked PPP unless they weren't able to, but that all really got turned on its head with the Taxpayer Certainty and Disaster Relief Act of 2020, call it the Relief Act. That was December 27th of 2020. Basically it said, hey, just kidding. Not only is this, for 2020, but it's, actually for 2021, the first 2 quarters, it's no longer, 50% for an entire year. It's now 70% per quarter. And so now at this point, we're up to possibly $19,000 per employee as opposed to $5,000 per employee. And then the new Congress comes in, new administration comes in, and they do the American Rescue Plan, or ARP, March 11th, 2021. And that said, oh, just kidding. Not only is it, quarters 1 and quarter 2, but it's actually quarter 3 and quarter 4. We're going to introduce this idea of a recovery startup business, and everything's great. And then just to make sure people were still paying attention, Congress, the administration, passed the Infrastructure Investment and Jobs Act. We call it the Infrastructure Act. That was November 15th, 2021. And it said, hey, just kidding. You thought you were getting Q4, but that's actually not the case anymore, unless you're a recovery startup business. So it's evolved over more than a year, from something that was relatively limited, and that sort of trend line has been to make it easier to get, and we'll go through some of those things. This is the guidance that basically everything we know about the ERC comes from these 6 writings from the IRS, in addition to the statute itself. Notice 2021-20 is really the notice. It sort of provides the color and fills in the gaps for at least what the government's position is vis-a-vis the employee retention credit. And then just lastly, before we get into some of the details, this is different than PPP. PPP was the 7A program of the SBA that was administered by the banks. In that program, you went to the bank and you provided documentation, you supported your claim, someone blessed it, both sort of to get the loan, that it was the correct amount, and then on the back end as well to say, look, I used it for what I said I was supposed to use it, or used it for what I was supposed to use it for, and you ought to give me forgiveness. And the SBA has come behind and certainly looked at some of them, but in large part, you had someone, or in PPP land, you had someone blessing what you were doing. This is different. This is built on employment tax and employment tax returns. So just generally, employers file forms 941 quarterly to report wages paid to employees and self-assessed employment taxes. And the employer pays its share, the employee pays its share, the employer is withholding an amount to pay for income tax as well. And for whatever reason, Congress chose this to be the vehicle to claim ERC. So in most situations, or in all situations, you should have filed your forms 941. Now you're going to amend it if you're going to try to claim the employee retention credit.
What is it? What are we talking about? The employee retention credit is a refundable credit. What does that mean? You can get cash. This is not some nebulous carry forward. In 25 years, I will have gotten all of my $18,000 kind of credit. This is a check the government's going to write to you for each payroll tax return that you're eligible for. Like Peter said, it's on your payroll tax forms. Each quarter is going to have its own eligibility analysis. Sometimes you're going to be eligible for the whole quarter. Sometimes you're going to be eligible for like 9 days in the quarter. We have those. And if you put a payroll in there, then it works out, and it's still worth doing to see if you can get some extra relief. But each quarter that you're eligible for, they're going to send you a check with interest for each quarter. So for 2020, the credit is 50% of qualified wages up to $10,000 for the entire year. So it's $5,000 max per employee. Now for 2021, I said this earlier, but it bears repeating, the eligibility, the amount of the credit changed when Congress updated passed new legislation to 70% of up to $10,000 in qualified wages per quarter. So that added an additional $21,000 of possible credit or refund cash that you're eligible for, making the total $26,000 per employee if you're eligible for all periods. That's an incredible amount. It really, we've seen people get, $18,000, $12,000, $5,000. We've seen people get, smaller credits. We've also seen people get like $1.3 million. We've seen people get, $900,000. We've really seen some incredible amounts of refund that's been going to our clients. How are you eligible? First, you have to be an eligible employer. What is an eligible employer? You're carrying on a trade or business during the calendar quarter for which the credit is determined. And you need to be operating. And you're going to qualify for either two methods, sorry. Method one, gross receipt test. A significant decline in gross receipts, you will qualify. The gross receipt decline doesn't have to have anything to do with COVID. You can have lost a contract, closed locations, just didn't do as good, and you will be able to qualify based on gross receipts. For 2020, you need a 50% decline quarter over quarter in order to qualify. That's a pretty hefty burden. But for 2021, when Congress increased the credit, they also made it easier to get. And all you need is a 20% decline quarter over quarter from 2021 to 2019, which allows eligibility. In addition, they also put in this alternative reference period for 2021. So if Q1 of 2021, you dropped 20%, in Q2, say you dropped 20.2%. And in Q2, you increase your sales by 1,000%, you're still eligible for Q2. Your payroll might have gone like astronomically bigger, might have gotten smaller, who knows, but you're eligible for that successive quarter automatically based on the prior quarter's reduction in gross receipts. A lot of people get concerned about that and don't understand and feel like it's not right, but my revenue went up. How is this possible that I qualify in gross receipts? Because this is the way the rules work. So this is how you're going to be eligible. This is the easiest test. We tell everyone to do the gross receipts test first. You're looking at income in, dollars in the door. It's not a legal analysis. It's not complicated. It's just a matter of like looking at your profit and loss statements quarterly and making a determination of whether or not you meet that test. So this is where Peter and I spend, I'm going to up it to 85%, even though he said like 99%. This is what we spend our time doing for the most part, determining whether or not businesses qualify based on a full or partial suspension of operations. So the operation of the trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to the coronavirus disease 2019. So here, it has to be because of COVID. It has to relate to a government order. It has to be directed onto your business, not somebody else's business that's in the same field and you thought that it was similar. So you took these precautions because you wanted to be responsible. It has to be like eminent domain. The government came in and bulldozed a part of your backyard. If the government is coming in and taking something that's yours because the order is directed to you, it is due to COVID and it restricted the way that you operate by more than a nominal portion, which the IRS is deemed to be 10% of your revenue or hours worked in 2019, then you can be eligible. I'm going to go to the next slide. So nominal in this instance is equal to 10% or greater of either sales or hours worked in the applicable quarter, or nominal effect of operating is impacted by 10% or more of the employer's ability to provide goods or services. So we say this is really easy when, dining rooms are shut down. You're able to carry out and nothing more. Okay, that portion of your business is restricted. That portion of your business represents more than 10%. We are able to move on. You're eligible. But what happens when the government says, okay, 50% capacity, 75% capacity, 6-foot social distancing? At what point are you no longer restricted by more than a nominal portion? And that's going to be a facts and circumstances test that you need to talk to, a professional about or figure out is whether or not you believe that you're going to qualify under that method. Do you want to add anything?
Nah, I'm good.
I will just unmuted all of you because it's a small group, so feel free to hop in with questions.
Yeah, jump in and ask me questions. This is the meat and potatoes of the credit. This is the tough stuff. There's some other tough stuff too, but as far as the eligible employer analysis, this is the tough stuff. So you've got to, Rebecca said it's easy when someone's fully closed. It's really the evaluation of these modifications when you're allowed to reopen to say, well, am I still restricted? It's one thing when the government says you can't open your storefront and you don't have e-commerce built out and you don't have, the online orders and any other sort of revenue stream happening. That's a full suspension. A dining room being closed, okay, you do have carry out, you do have drive through, you could get a Grubhub account. That's still a partial suspension. That's pretty easy, right? They're completely saying that part of your business can't operate, and you go back and you look at the testing period in 2019 and you say, well, okay, this was more than nominal because it was more than 10% of my total hours worked or total gross receipts. Then it's really a question of, okay, well, now they're starting to say I can open up. So I'm allowed to be open. I don't have a full closure of anything, but they're still saying I can't do it in the same way that I did it before. And I think that's the hard part, is working through the nominal effect analysis of, was my ability to provide goods and services in the normal course impacted by not less than 10%? 10% of what? They don't tell us. You certainly could think of it in terms of a gross receipts or hours worked analysis, but that might not line up, right? And so you've got to be able to articulate, I think, exactly, how these orders continued to impact the business as a whole. So moving on, unless seriously unmute yourselves and ask questions if you have any. We'll have some Q&A at the end, of course, but sometimes it helps to do it, as it's going. So don't hesitate. There's a third way to qualify that is was introduced in the American Rescue Plan. That is, definitionally, it means the business began operations after February 15th, 2020. If you were before, sorry about it, but you can't be a recovery startup business. You averaged less than 1 million gross receipts annually. This is a Section 448 analysis. You're testing sort of 2018, 19, 20 to see what was going on. You'd probably think, well, that's crazy because it just began February 15th, 2020. But the catch here is that you may have, a controlled group of corporations, whether it's a parent subsidiary situation or, brother sister control group or combined, you've got to consider the receipts of everything for purposes of the credit. By definition, this means you don't qualify. If you're a recovery startup business, it means you don't qualify by methods 1 or 2. The credit is limited only to Q3 2021 and Q4 2021. and you cannot exceed 50,000 per quarter. So what are they doing here? They basically are saying, well, you started a new business during a pandemic, you took a risk, you survived, and nevertheless had employees in quarter 3 and quarter 4 in 2021, and we're going to reward you if you're not qualified under one of these other methods. This is the only way to still qualify for Q4 2020 because they pulled it back with the Infrastructure Act largely. The other catch is that it's only 50,000 per quarter, so max recovery startup business is able to take advantage of 100,000. It doesn't mean that a recovery startup business couldn't start while restricted. So you may qualify in other calendar quarters as a restricted business, but then as things open back up, maybe you're no longer restricted by these orders. It's not creating a more than nominal effect. And now you're just into quarter 3 and quarter 4, but they're still, again, sort of rewarding your starting a business during a pandemic. So everything we've been talking about so far has been eligible employer. You could be an eligible employer and not have paid qualified wages. And certainly we have spoken to some folks who are, you only have family on payroll and you're getting jammed up by deemed ownership rules and you're backing out those wages. And then when all is said and done, you didn't pay any qualified wages. But we'll get into some of those unique situations. But qualified wage, for the most part, is any wage paid, to an employee during the time that you're an eligible employer up to $10,000. So they cap that $10,000 either for the entire year for 2020 or per quarter in 2021. The other big issue with this then is whether or not in 2019 the business averaged 100 or fewer or 100 or 500 or fewer full-time employees in 2019. So basically they're testing for whether or not you're a large employer. The rule is different for 2020 versus 2021. They tell you to go and look at 2019, and if you had 100 or more or 500 or more, then it's going to change the definition of a qualified wage for the purposes of the credit. And the way that it changes the definition is to say that qualified wages are only those wages paid to employees who are not providing services to the company during that period of eligibility. So they want you to pay somebody to stay home. A couple of points about that. One is it's not a cliff. So you could, still pay someone who is both providing services and not providing services. So maybe you need somebody for 15 hours a week, but you nevertheless pay them 40 hours a week. If you're a large employer, you would be able to claim qualified wages for the 25 hours that they were not providing service. The other thing to point out is the way the IRS has explained this rule is to determine whether or not somebody worked basically 130 hours per month. It's grabbing the Affordable Care Act definitional stuff. And so it's 30 hours a week on average. They've interpreted that as 130 hours per month. So go back to 2019, add up all the employees who worked more than 130 hours or more, add up all those months, divide by 12 or divide by however many months you were open, and that's going to give you your average full-time employees. So it's generally not a full-time equivalent analysis. At least that is the analysis that the IRS has said. And they've mentioned it several times in their notices. So again, different rule for 2021. They've made it easier to get. They popped that number from 100 up to 500.
You guys all quiet, seeing from paying attention. I'm paying attention. Limitations and refunds. So, as we said, the wages taken into account is going to cap at 10,000. Recovery startup businesses, you can only get $50,000 for full quarters of refund. The most important thing, if you could take away nothing else from this discussion, refunds of excess credit is a check. It is cash to the business. It's presuming that you don't have any outstanding tax liabilities, obviously, but it is most circumstances, cash to the business for each quarter. So it really is an awesome program. Next slide. So impact of other credit relief provisions. You can't take the same wage twice. So you can't take PPP and ERC in the same, for the same wage, for the same dollar. So if I pay Peter, $25,000 for, 2021 income, you're going to have to look at it and be like, okay, well, I can take 10,000 for, well, I guess that wouldn't be the right math, but let's say he's got $15,000 for Q1. You take 10,000 for ERC, you have 5,000 left for PPP. It's a way for you to make sure that you're not using the same dollar. What we do is we create a work paper that shows your PPP wages, your ERC wages, FFCRA, RF, I don't know how much more alphabet soup you guys have, but whatever's there, we create a spreadsheet that shows where each dollar went. So when the IRS comes in a couple of years and says, hey, where'd you get these numbers from? You can say, hey, my tax attorney or my CPA provided me this beautiful work paper that shows exactly where it came from. It's very important. How do you claim the credit? You're going to claim the credit on the 941. I was talking about how I don't like this form. I had my first experience with it back in 2014 when I had my daughter and I had to have a nanny and figure it all out. And then this ERC has not made me any more in love with the 941. They've added some pages to it. There's a lot of lines where you're backing out different credits and other things. It's a real big pain. Then with each 941, your preparer or you need to prepare this worksheet, I should say. It adds up what the credit is for each employee. This does not get filed. The IRS is not reviewing this. The IRS is not blessing your return when you file it to say you did the right thing. What they do is they say in 2 years, hey, where's your worksheet we told you to keep for your records? And you have to be able to produce it. You want to produce that, you want to produce your PPP work paper. Peter will get into some other things that you need to keep as well, like government orders and things like that. But it's really important that you spend the time now to do all of this. So in 2 years, you're not trying to recreate records when there's things that just don't exist anymore.
Yeah. So in this situation, they've actually told us, this is what we're going to ask for if we come in and audit. If you are qualifying based on, full or partial suspension of trade or business operations, you need to have those orders that you're relying on. Keep in mind these things sort of popped up and got tweaked and then or I guess some expired and then they got reestablished and then they got amended. And when we're going to pull these things, we oftentimes end up with hundreds and hundreds of pages of governmental orders. Keep in mind also that sort of these things are starting to come down from websites, especially as sort of political administrations are changing, or a new governor comes into town. He or she gets a new website, like that kind of stuff is definitely starting to happen, where we're having to use the Wayback Machine and hope that it happened to scan that corner of the internet on any particular day. So just time is of the essence for some of that stuff. If you're qualifying based on a significant decline in gross receipts, you're going to need the data to support that, right? Just like any other audit. Typically, that's going to be a quarterly P&L, so you can show here's what it was in 2019, here's what it was in 2020. But you're going to want to make sure that your accounting was correct. That if you're required to be an accrual basis taxpayer, because of Section 448, that your quarterly P&Ls are and your accounting is booked that way. Or if you're a cash basis, you just want to, those are the types of issues that you could see there. Records of qualified wages, that's probably the easiest is payroll data. But if you're a large employer, you need evidence to show that wages were paid to an employee who was not providing services to the employer. Probably that's timesheets, time cards, something along those lines to show. It'd be great if you had multiple line items on a check or something, but probably not. Documentation for health plan expenses. So we didn't mention it previously, but health plan expenses are considered qualified wages. So to the extent you have some PPP offsets or RRF, FSCRA, whatever they are, you're able to come back in with health plan expenses and to sort of top it off. To again try to get you up to that 10,000, because you're really trying to fill up the ERC bucket and making sure that you're not taking any inconsistent position with the Form 3508 forgiveness application that you've already, claimed ERC forgiveness. So I don't think, I know you don't want to be in a situation where you're saying, well, I used 100% for PPP forgiveness, even though you could have backed it down to 60, right? It was a 60-40 thing. I think you have to stay consistent with what was on that form. Documentation of aggregate group employer determination. We'll talk about a little bit of that on the next slide. Completed forms 7,200 submitted to the IRS. 7,200 was an advance claim for the credit. So they set up the situation where you could claim it even before you were filing the 941 because they thought they were going to be able to get cash back into the businesses faster, keep people employed. That didn't happen. It never happened. And then copies of employment tax returns. They say keep it for 4 years. I say keep it for 5. I'll tell you why on the next slide. So, right, like everything sounds great. Everybody's getting all this money. There's definitely some catches here. And this slide is just intended to say, I remember he said this. I'm seeing this now. I need to slow down and work through this stuff. So this is built on tax rules that already existed. It specifically references section 52 and 414. 52 references 1563 for controlled groups. This is aggregation stuff. It's situations where multiple entities, multiple employers will be treated as one employer for purposes of the credit. And when you go then to apply that to the credit, it has weird results. So like if you are trying to qualify based on a significant decline in gross receipts, you can't just consider your restaurant, which lost money. You also have to consider your construction company, which went gangbusters. And you have to, blend them together to determine, well, did I have a significant decline in gross receipts? It's a little bit different when you're working on the full or partial suspension analysis, but you still have to know employee counts for purposes, or you have to know control groups for purposes of employee counts. It's just, if you've got multiple businesses, you need to know whether or not it's a control group. There are some very strange and somewhat frustrating family attribution rules as well. So if you have ownership with other family members, that's another opportunity to slow down and make sure that other things that other family members own is not getting pulled in, because that can certainly happen. Majority owners or deemed owners' wages are not considered qualified wages. So that's not a situation where you're 50-50 with somebody, because there you don't have a majority owner, unless family attribution rules could apply there. Deemed owner wages, so you could have, generally close family members working in a company, but in that situation, it's even, step family relationships and in-law family relationships that are also, going to get pulled in. All is not lost when this kind of stuff happens, because there's some strategy as far as, loading up somebody whose wages are not considered qualified as PPP wages and not ERC wages. And then, you're not taking inconsistent positions. So just slow down if you've got family members working in the business. And if you have a majority owner, for sure, their wages aren't going to be considered. If you acquired a business during COVID, you need to slow down and just work through, especially with the significant decline gross receipts issues. You're going to, certainly include those gross receipts while you own the business. But the question is, well, what do I do? What can I do, when I didn't own the business, because you want to test for a decline. And, it seems unfair to only use it on one side, right? So to the extent that information, I think you can grab it on the other side. Sole proprietor income is not eligible. This is different than PPP. So if you're a sole prop filing on Schedule C, PPP, everybody was asking you for, a copy of your Schedule C line 31 net business income. That's not what this is. you know, you certainly can still have wages paid and have employees as sole prop, but, you know, in an effort to sort of create parity with the majority owner situation, you know, that sole prop's net business income is not going to count. Sorry to Rebecca's nanny household employers aren't eligible. The next two are important. So the assessment statute expiration date, so how long the government has to come back in and audit you, generally is 3 years and remains 3 years for most of the years in calendar quarters to which ERC may apply, but not to quarters 3 and quarter 4 of 2021. They gave themselves an extra 2 years in the American Rescue Plan to come back and audit. So just bear that in mind. If you have the quarter 3 or quarter 4 claim, there's a longer statute for them to come back and do the assessment. Refund claim statutes are not extended. The refund claim statutes are what control due dates here. So refunds related to 2020 are due by April 15th, 2024. Refunds related to calendar quarters in 2021 are due April 15th, 2025. And then lastly, before we open it up to questions, just, you know, want to make sure you realize that because of the operation of Code Section 280C, you're going to pay income tax on the amount of the credit. So Section 280C says that if you get a credit based on wages paid, you lose the deduction for the wages up to the amount of the credit. What the government has said is they want you to amend the tax returns which claim the wages that generated the credit for you. So what that means is going back and amending 2020 or 2021 or both, depending on your eligibility. And, you know, if it's a C Corp, the C Corp's going to pay the tax. If it's a pass-through, just keep in mind that's going to generate an amended K-1. Those are going to go to the individual partners in most circumstances. There's some exception to that, possibly. But it's going to generate tax. Somebody's going to have to pay tax on this in almost all circumstances. And, you know, 99 point something percent of the time, it still makes sense to claim the credit. You know, the numbers here, the 70% multiplier, the 50% multiplier, it's generating big numbers here. And in this situation, like, the tax has already been paid, so this is all just refundable credit, frankly. So don't be afraid of the tax treatment. You know, if you're talking to somebody, make sure that, you know, they're talking to you about, you know, here's your top line number, but this is what, you know, you should actually expect at the end of the day. And with that, I invite you guys to unmute, ask any questions that you have. Rebecca, you're still muted.
I came back. Something weird happened. I think Brian is trying to check to see if I'm willing to talk. So yeah, I know some of this is clear as mud, but essentially what we do is we're willing to scope these cases for free. I know some of you all who are participating are in that process where we're determining whether or not you're eligible, looking at your business, looking at your payroll and all of that. For those that aren't doing that, you know, our process is we scope the cases for free, make a determination on what you're eligible for, and then we'll quote you a fixed fee to be paid once everything kind of processes. So we don't want people like coming out of pocket to find out they're not eligible for a credit, because that would stink, and we try not to do that. So Peter and I have been studying this stuff since March 16th of 2020, when our kids were no longer allowed to go to school anymore. And yeah, I have some PTSD from that whole process, but we've been spending so much time on this stuff. We really, really encourage everyone to reach out, ask us questions. We're happy to answer them. I said earlier, it's like you want to be Def Leppard in 1992 and not Def Leppard, or 1987 and not Def Leppard in, 2022. We want to be cool when it's still cool. So call us now, because in 2 years, no one's going to care about this stuff. And then we'll have to learn something brand new. So while the knowledge is there, take advantage of it. We're happy to answer random off questions. Your brothers, sisters, sons, business was selling Girl Scout, whatever it is. We're happy to do that. Our information's there. Shoot us an email. And we look forward to hearing from you. All right. All right. Thanks, guys. We appreciate it.
Yeah.
Bye.